One of the biggest challenges that happens with retirement planning is runaway portfolios. This is when someone does not appropriately or frequently rebalance their portfolio and they end up with extremely concentrated positions that make their portfolio risky later when markets correct or behave out of the ordinary. Frequently, this happens because when markets are functioning the way we hope, which is growing and traveling in the right direction, we don't pay too much attention and we let our winners really ride. The problem occurs when later the correction occurs and we have an outsized or disproportionate damage to our portfolio because the risk, let's say the risk side of our portfolio has grown disproportionately and now shrinks disproportionately because it is larger as a proportion of our overall investment portfolio. In this video, we're going to talk about how to appropriately rebalance your retirement portfolio. We're going to go through the common strategies and then the strategies we prefer at Peak Financial Planning. So there are really three types of retirement portfolio rebalancing strategies, starting from the simplest and then getting to the more complex. The first mechanism of portfolio rebalancing is what's called calendar rebalancing. This is where you might rebalance your portfolio one time a year or one time a quarter based on a reminder on your calendar that just says at this day or at this day and time, I rebalance my portfolio from its current weightings back to its original weightings. You would use a simple asset allocation model in order to do this. You can't use anything more complex in order to do this. And you're avoiding or not using any market timing or any types of performance-based rebalancing, which makes this the simplest to execute. If you're a buy and hold investor and are not really interested in doing anything more complex, this is probably one of the easier mechanisms to use. The second portfolio rebalancing strategy is what's called threshold or guardrail or band rebalancing. And this is where you might say, hey, if I start with a 60% stock, 40% bond allocation, I will rebalance my portfolio anytime the portfolio has a 10% change in the actual target weights. What that would mean is if my portfolio goes from 60% stock to 70% stock, I rebalance back to 60% stock by selling 10% of my stock-based investments and shoveling those back into my bond or conservative-based investments. Now, if you've watched other videos of mine, you know that we don't believe asset allocations are a useful mechanism for constructing portfolios. And so this leads to the third portfolio rebalancing technique that we prefer. The reasoning being mostly, I don't believe that asset allocation is a useful guide. And if you want to use threshold-based or calendar-based rebalancing, you really have to rely on asset allocation to supply you the bands or the targets for your rebalancing efforts, because the simplicity of the system will only allow for asset allocation to be used. If you've watched other videos, you know that I believe that part of the downfall of asset allocation as the main guide behind portfolio construction is the fact that it is overly simplified and therefore doesn't provide enough substance. The third mechanism for retirement portfolio rebalancing is a combination of bucketing plus what I would call investment specific or individual investment weighting rebalancing. So I'm going to actually do a screen share here and show you this in real time so you can see exactly how this might look. All right, so we're going to go through an example of our preferred rebalancing strategy here. It's a two-step process. The first step is we're going to create some kind of a bucketing mechanism. Whether we actually use a formal bucket strategy or not is irrelevant here, but we're going to use a bucketing mechanism to help us understand our different types of investment bands. We're going to use always cash or cash requirements as the starting requirement in order to build these bands. And the way we generate that cash requirement is we use our required portfolio income formula, which you can see in other videos on our channel, and we'll link to those up above the video here. But the idea is you take your desired spending, you subtract from that your guaranteed sources of income like Social Security, pensions, and annuities, and you're left with what's called required portfolio income, which is the amount of income your portfolio actually needs to produce for you on an annual basis. And then what you do is you create a cash bucket that is based on a certain number of years of that required portfolio income. So in this example, we're going to use 5 years of cash, which you can see here on the little chart. And once we do this math, let's say this person requires $17,000 per year of portfolio income, their cash bucket needs to be $85,000 at any given time. And then what we do is we back out the other two portions of our portfolio. And we're not really using asset allocation as a driving mechanism for this, but we will show the different bands of our portfolio as a percent of our total portfolio value or our total wealth for the ease of illustration here. So with an 8.5% cash bucket, we now have also a 31.5% what I call downside protection bucket, and then a 60% growth bucket. This yields a total portfolio value of $1 million. And now we can move from here and talk about how we would use investment specific rebalancing in order to manage our risk in a portfolio. The key danger we're trying to mitigate with portfolio rebalancing is what's called concentration risk. And that's where certain positions run away and get too large and become too large of a proportion of the total portfolio, and therefore cause disproportionate risk should something happen to that position or to that sector or economic variable, and causes a downside movement that is larger than we would want or expect. So what we're using here is what's called position-specific rebalancing, where we actually assign a maximum position size that we will allow for any one position in our portfolio. And I'm just showing an example here of a single stock portfolio, but you could take this for what it's worth on any kind of mechanism. You could use ETFs, mutual funds, or a 3-fund or 5-fund portfolio and still do the same thing. What we say to ourselves is, what is the largest position size we are comfortable with, beyond which we are too concentrated and therefore face too much risk if that position were to have some kind of, major negative event. Using this as an example, let's say we assign a 5% maximum position size. Well, that's the largest we ever want things to get. We take our original position weighting, which is here, and we say, hey, we have 6 stocks. Microsoft is 2.5% of the portfolio. Amazon is 2%, and so on down this chart, this grid. And here's the actual dollar amount of the portfolio. Well, let's say these positions grow and some of them start hitting our threshold. You can see that's the second chart here. After growth, now Microsoft is 6% of the portfolio when we prefer it to be 2.5%. What we would do at this point is rebalance the positions that have triggered or bounced past our maximum position size and rebalance them to our original or our target weight for that position, and reallocate funds to other positions that are now below their target weight. And in this manner, we can let single positions ride and optimize for growth and rebalance to other positions when they're a smaller proportion of the portfolio. One of the critical elements here is you do have to pick a maximum position size as a rule and then live by that rule. Meaning, if you think that a starting position for Microsoft of 2.5% and a maximum position size of 5% doesn't give that position enough room to run, well, then you need to extend your maximum position size. The main thing is you cannot deviate from this rule. You have to set it as a rule and then live by it, or you'll start making flexible changes all the time, and then you'll end up with the same problem as though you had never used a performance or a portfolio rebalancing strategy to begin with, and you'll end up with over or highly concentrated positions that present too much risk in your portfolio. Wind things down here, the main objective of portfolio rebalancing is, again, to reduce concentration risk so you don't face disproportionate levels of risk because one position is too large a proportion of your portfolio. I hope the visuals helped. Again, going at this and choosing your own portfolio rebalancing strategy should be done through the lens of, do I want a simple or complex system to manage? And obviously you will trade efficiency or effectiveness as you move towards simpler methods of managing this type of activity. Anyways, I hope you found this video helpful. Thank you as always for your time and attention. If you have comments, questions, or suggestions about this video or future topics that you'd like us to address, please leave those in the comments section below. As always, you can find more information and helpful guides on our website at www.thepeakfp.com, including things like sample financial plan, 3-bucket strategy, asset allocation articles, and a whole bunch more helpful information. If you'd like to schedule a free consultation with our fee-only fiduciary financial planning team, you can do that on our website as well at www.thepeakfp.com. And with that, thank you as always for your time and attention, and see you in the next video.